Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And we have a real powerhouse on the show today. His name is Michael Episcope, and Michael is the CEO and principal or co-founder of Origin Invest, or co-CEO of Origin Investments. And, you know, Michael's done pushing $1 billion worth of transactions with a B. Present portfolios valued over almost $500 million or more than $500 million. And, you know, I'm not going to do his bio or history any justice, so we're going to go right to you, Michael. Welcome to the show, buddy.
Thanks, Rod. Appreciate you having me on today.
Absolutely. So, you know, you've done so much. Maybe you could take us back a little bit and tell us how the story started and how you got to this incredible success that you're at right now, and why real estate and why the particular asset classes that you focus on. I know you do multifamily and office, but, you know, obviously our focus is multifamily, but talk about how you got going.
Yeah, I'd be happy to. I'll take you back a little bit farther maybe than you want to go, but born and raised in the Chicago area. I actually, my first career was in commodities trading. I went to school in Chicago. I went to DePaul University as an undergrad, and between my freshman and sophomore year, I got a job on the floor of the Chicago Mercantile Exchange and decided I loved it. And that was the start of a 16-year career there. And of that 16 years, I traded for about 10 years. And that's really where I built my wealth. And it was a phenomenal time, a great experience. And, you know, when I exited that area in 2005, it was really about taking the next stage, which is how do I protect and preserve and grow my wealth and beyond stocks and bonds. And my experience in real estate actually extends back to, you know, kind of when I was 11, 12, 13, working for my grandfather in the summers. He actually managed and owned a lot of Class C workforce housing. I think Class C might be generous in some of that stuff. You know, I used to spend my summers with him, and I really...
In Chicago.
You know, in Chicago, yeah. And it really afforded him a lifestyle, you know, and it was nice. And I saw the impact that, you know, real estate and good real estate, you know, like proper real estate investing could make. And it was in the late 90s, early 2000s that I began passive investing. And what I learned through that experience was that a couple things. Number one, real estate, especially in the private market, sometimes it's not so friendly for the individual investor. And it was very challenging to find good quality deals, good quality managers. And there was, you know, this big gap between the large institutions, family office, those who had a lot of money, an investor looking to put in $500,000, $1 million, $5 million, even $10 million, you know, with a manager. So I had some okay experiences. I had some, you know, not so great experiences as well.
As a passive investor in other deals.
As a passive investor, yes. And it's sort of, you know, getting my point. The other thing that I learned is that it's a heck of a lot more complex than, you know, what people realize. I mean, these are, you know, Rod, you're really experienced in this area as well, but these are little mini companies that you have. And it's not so much as, you know, simplifying and saying, hey, this is a physical asset and this is it. There's a lot of ways that you can really get your face ripped off in this industry. So, you know, it was in 2007 that my partner and I got together and we decided, you know, kind of came to the same conclusion that we can do this better with our own capital. We pulled our capital together, we built a firm, and it's, you know, that was kind of the impetus of us starting together. Is we just wanted to build a firm around our capital that would represent us as individual investors in a way that, you know, where we could take advantage of the market and take advantage of real estate investing and realize its true benefits. And
this was in 07.
Yes, we got together in 07, and in the beginning, in the first 2 years, it was all our own capital. And when I transitioned out of commodities trading in 05, I went back and I went to, got a master's in real estate at DePaul University as well, retooled from that sense. And that was a great experience. I was sort of the you know, at 35 years of age, I was the old guy in the class, which was kind of fun as well. But, you know, I just, you know, I believe in continuing with education and learning and things like that. It's a big component of what we do today. And, but, you know, Origin, it's not only, you know, when you're sitting there and you're a principal and you have so much of your money invested, the decisions you make around the investments you select, the team you select and put around you as well. It all is influenced by that notion of alignment and where you sit. And I think being an investor at the firm and a manager and a principal puts me and my partner in a very unique position. And even when it comes to things like understanding what investors want, I think where a lot of managers, they don't understand the importance of reporting and communicating. And that's something that we've taken to heart, and we understand that is just as important as generating returns, letting investors know how you're doing it, providing them with guidance, clear understanding of where they stand every day.
Sure. No, it's critical. I mean, any time these relationships fail, it's through a lack of communication. So, that's absolutely a great point. Those of you that are doing your own syndications, do not short circuit that process. You have to over communicate and, give your investors comfort. So, I know that. You've done several funds, and we started talking about that before we started recording, and they're fairly sophisticated. But I'd like you to break down why you like a fund versus individual syndications for specific properties, because you touched on it with me offline, and I'd like my listeners to hear that.
Yeah, I'm happy to talk about that a little bit. I think when we create structures here, we create structures around how we want to invest our capital. And I think that a fund has a couple advantages over an individual deal syndication. Number one, if you're a passive investor and you're not a full-time real estate investor in this market, I think it would be very challenging for you to ascertain, one good deal from another good deal from another. And in this business, it's really about selecting the right manager, the right people. And if you get that right, then that's who you really want to put your money with, whether it's a syndicate or a fund. But the point is that, in a fund, you make that one choice of who do you want to invest with, what's their strategy. So you have one point of due diligence. And once you make a commitment to the fund, what happens then is that as we buy assets, we call capital. So if you make a $100,000 commitment to the fund, we don't take it all up front because we don't have a portfolio of assets. You're hiring us to build your portfolio. And now that money can be spread across 15 to 20 deals over asset class, because we do multifamily and office, by geography, because we're in 8 different cities around the United States, and also by vintage as well, which is important because we will be investing over a period of 2 to 3 years and building that portfolio. We talked a little bit about the fee structure and the importance of that. And, there's, I think, this misnomer that funds are actually more expensive than individual deals, and that's just not true. I think in any deal, first of all, I think there's nothing more expensive than low-cost real estate, so investors have to be careful about, making determination based on fees alone. But I just wrote an article on this, and funds just charge differently. An individual syndicator, they charge acquisition fees where a fund doesn't. A fund will charge committed capital fees. There's nuances behind here. But I think where it comes down to is this notion of alignment. And with a fund manager, if we have 20 properties in the fund, in order for us to make a performance fee at the end of the day, and the performance fee is what happens at the end when things go well, we get a percentage of the profits. All of our deals have to work well together. And in order for us to get paid cumulatively, our fund has to generate more than a 9% return. So if we have 2 or 3 deals that don't perform and the fund only generates 8%, we don't get paid a performance fee. That's very different if you're buying 20 individual deals. If 10 do well and 10 don't do well, you're paying a performance fee on the 10 that do well in that structure because your performance fees aren't cross-collateralized at the fund level. So that's one of the distinct advantages. But it comes down to creating structures that we want to invest in. And, in whatever I do, even in my personal life, I only invest in fund structures because, I think maybe I know a little bit too much about that. But if I was looking at individual deals, I would have no clue about how to ascertain one from the other because it's not what I do full time in any business. So, if I were outside of this business, I would invest in a fund.
Yeah, I mean that's why the index funds are the largest, on the planet. They're $1 trillion funds these days in the stock market. That is now. So, As now, just let's talk a little bit more about fee structure, because I just want to make sure. So you don't charge an acquisition fee. You charge a capital. What did you describe that as? Because this is a little
So
new to
it's
me.
a capital commitment fee. So when
Okay.
an investor commits to a fund,
Hmm.
they start paying fees on their entire commitment on the day they commit.
I see.
So that's a
Interesting.
little bit on the equity amount. So in our
Okay.
fund, we charge a 1.5% annual management fee on committed capital that ultimately reverts to invested capital. And on a
Okay.
syndicator deal, what they will do is that they don't charge on committed capital, they charge an acquisition fee because, and for every deal that they do end up finding, there's probably 20 deals that they didn't find that they had to pay their expenses. So it's a different way of getting to the same place.
Okay.
Now, there are funds out there that charge both a committed fee and an acquisition fee, and I would caution people, that can really eat away at returns, but we have adopted institutional fee structure.
What other ongoing fees? I assume there's an asset management fee. What other sorts of fees can a person expect in a vehicle like yours?
Well, in our vehicle, what we do is we have a one-time upfront one-time upfront fee that's basically covers our technology, our fund syndication costs, our marketing, everything, and that's anywhere between 1.5% and 3% on a one-time. Ongoing, then it's 1.5% on the fund on an annual basis. It's committed that ultimately reverts to invested equity, and then on the back end, we have a 20% performance fee. So we don't have any debt placement fees. We don't have any acquisition fees in our fund. And again, we feel that is an institutional pricing standard in the business.
Okay. Very interesting. Very interesting. So what are the 8 markets that you're in?
So we're in Chicago, Denver, Dallas, Austin, Houston, and then Charlotte, Raleigh, and Atlanta. And we're in those markets because in the strategy sense, the first thing we do is look at the macro view of the world and figure out where we want to invest, what markets are growing. Because as you know, Rod, population centers, job growth, population growth, that's where you want to position yourself.
Most important parameter.
Yeah, especially in assets, because we're more of a buy, fix, sell strategy where we're buying underperforming assets. And if we lose a tenant or we have to backfill a tenant, we need to do that. We need to know that there's robust job market growth in there. And then within those submarkets, we focus more on the high income demographic areas. So we're looking at more of the B+, A- quality assets within those submarkets. And it's for our acquisition team who are in their markets, it's a very defined parameter. So not only do they know exactly what they're doing every day and where they're hunting, but the brokerage community and the ownership community and the management community knows what we're looking for as well. So, the more we've refined our strategy over the years and actually narrowed the focus, the more prolific and just more efficient we've become at finding deals.
Yeah, and that's a big clue, guys. If you try to be a generalist, frankly, in any business, in fact, I just preached about this in my live event, How to Think and Grow Rich. How, Napoleon Hill said the key to success is specialized knowledge. You have to be a specialist. You need to shoot with a rifle instead of a shotgun. So there's another great
good advice.
Another great tip on that.
Mile deep.
So you're a buy, fix, and sell investor. You don't hold any properties for legacy or long-term cash flow.
No, we don't. Although I will say that going into Fund 4, one thing we always do is from each fund, we're sort of iterating. We try to make it better and look at, the things that we do well, things that we can improve on and things like that. So as it stands today, we are buy, fix, sell. So typically the average hold period is probably about 3.5 years. Some assets we've sold in 1.5 years, some assets we hold for 5 or 6 years. But what we do is that we'll forego cash flow in the first 2 years. A business plan generally takes anywhere from 18 to 36 months. And instead of generating 7% on a stabilized asset, maybe we'll generate 12% in 2 years and we'll get some level of appreciation. It also, once we've improved the asset and grown the top line revenues, then we may hold it for a couple of more years to generate the cash flow and increase the multiple on equity. But going forward, we're actually, as much as I love the strategy of the buy, fix, sell, it also has its limitations, which is, real estate is incredibly tax efficient, but when you sell, you have to pay long-term capital gains. So even if you're reinvesting that capital, you're only reinvesting 75, cents of that profit rather than 100%. So, Fund 4, look for changes coming up in that strategy and more of a hybrid evergreen to, buy, fix, sell to more of a buy, fix, hold.
Oh, awesome. Now, let me ask you this. What are your thoughts on the looming contraction? What I'd love to get your insights and your thoughts on, obviously real estate goes through cycles. Everybody knows my $50 million seminar in '08, and I've been through other cycles as well that were equally impactful, negatively impactful. What are your thoughts about what's coming up on the horizon?
Yeah, I agree. I mean, no tree grows to the sky, right? I think it's not that we believe in timing the market. What we try to do here, risk management is a huge component of what we do. Again, I came from the commodities trading world. Say being a good trader was more about risk management than, trying to.
It's not how much you make, it's how much you don't lose.
Yeah,
right.
Exactly. So, some of the things we do is we're positioning ourselves in really high quality assets. I believe that value add is a way to protect yourself from, future downturns. If you can build value and continue to build cash flow in the asset, we leverage 2-to-1 debt to equity. We do
let me stop you there. So guys, just so you heard that, he's in at a third equity instead of, the typical agency debt is anywhere from, 20 to 25%. You're coming in at 33%. Is that correct?
Yeah, and even more importantly the debt has to match the business plan of the asset, and making sure, if we're buying an office building and there's a risk that one of the larger tenants may vacate over the next 2 years, then our debt today has to be matched to the potential exit of that tenant. So risk management, I think, is one of the things that we do well. And it's also, when we talk about it and we meet with investors, it's something that we talk about incessantly, and something, maybe we obsess about a little bit here about, what are growth rates going to be? What is the proper cap rate? What is the proper debt to equity structure? Why is the asset underperforming? Is it just bad real estate? Can we actually improve it and get what we think? And, the market's been great for the last couple of years, and it certainly will turn around at some point. And I believe that you buy good real estate, you add value to it, you appropriately capitalize it, and you have some dry powder on the side. So if things do happen, you'll be able to right the ship.
You can weather the storm.
Exactly. Okay. And Rod, just back to your other point, we talk about a fund advantage. One of the nice things, if you have an individual deal and it goes bad, you can't borrow from another transaction to right the ship in that deal, because chances are you have different investors across it. Well, in a fund structure, if you have one deal that needs capital and the other deal is doing very well and spewing off cash flow, all of that cash flow rolls up to the fund. And as a fund manager, we look at it more as a portfolio, and we can borrow from one asset to fix another and shore up. So you have
a diversification of risk, for sure.
Yeah, management of cash flow. And I'll never forget, one of my professors early on, this was actually in '06, but he said the 3 most important rules of real estate are never run out of money, never run out of money, and never run out of money.
No question.
And it was interesting. I mean, it came to fruition in '08, and you look at it, but there was some people who had some great real estate out there who over leveraged and ran out of money, and they had to give it back to the bank, or they had to sell it. And you look at it today and it's worth 2 to 3 times more than what they sold it for. So we're very good at managing our contingent liabilities, looking at risk at an individual asset level, but then the portfolio level as well.
So let me ask you this: you find an A- asset or a B+ asset. It's not like the heavy reposition that you would do on a C asset, where you're going in and completely redoing the interior and all that. What sorts? Give us an idea of what sorts of things you might do to add value to a nicer asset like that. Give us some examples.
Yeah, I mean, we actually just acquired an asset. I can give you a couple examples if you want. What we're trying to do is really take what we call core plus risk and deliver value-added returns. And that's certainly not as easy today as it was a couple of years ago when capital had so much more leverage. The markets are a little bit frothier today. There are deals to be had, but not as easy. Mm-hmm. back in 2015, this is a fun two asset. I'll take you through this because it's kind of right down the fairway for us. We bought an asset in Naperville, Illinois. Naperville is the third largest city in Illinois, an affluent community.
It's a Chicago burb.
Yeah, Chicago suburb. Yeah, and it was our second asset in Naperville, and it was suburban multifamily has been sort of out of favor, and we see all the cranes that are happening downtown, and everybody believes that every millennial is going to live in the city, and we just don't believe that. So as we've seen this rent gap between urban and suburban just widen, one of our theses is that we want to be in suburban multifamily. So when this swings and these millennials start moving out there, that we can position ourselves for that. And this was consistent with that thesis. Beautiful B+ asset, early 80s vintage, owned by the same individual who built it. His children managed the property, which that was, that's something that's unique. And
that can also be a big negative on behalf of the quality of that management.
Positive for us because to say that they didn't understand best practices around property management would be an understatement. So, you had an off-market deal in a great suburb, great physical quality asset. It also had a broken condo structure. And what was interesting about that is that the previous owner, because he was embarking on a condo structure, he actually upgraded all of what we'll call the non-revenue generating components of the property. He put on a new roof. He paved the parking lot. He made sure the tennis courts were doing great, the HVAC, all those things. So
just let me stop you for a second. So those that don't know what he's talking about here, back when things were going fast and loose in 05, 06, 07, a lot of apartment owners were condomizing those apartment complexes and selling them off one at a time. And when it all crashed and burned, there were a lot of broken ones where some of the units had been sold, which actually adds some complexity because you've got a homeowner, you've got an association associated with those units, so it's a kind of a complex thing to get into. But of course, you're absolutely fixing these units up to sell them as condos. Maybe you're putting in washers and dryers. You're doing things that you're certainly separating all the utilities, which can be a real asset to your bottom line if everything's separately metered. So anyway, I just want to explain that to my listeners that may not understand what a broken condo conversion is.
And he actually did. He did everything you're talking about, and he sold 19 out of 283 units. So what we did is we came in there and bought 264 apartment units with the idea that we were going to buy the other 19 units, put Humpty Dumpty back together again. And, it's everything we look for, but it's a good quality asset. And when we walked into these units, the 264 that we did acquire, it was like walking into a time warp. They had never been touched since the early 80s. And you look at all the low-hanging fruit that the management team wasn't, charging for. And so, I'll take it, but fast forward, to today, and it was 76% occupied at the time of acquisition. We're at 96% today. We're under contract for our very last unit, so it's taken a while to buy the other 18. But I will say that the condo owners were really stuck as well because you can't sell a condo in a broken structure. So
there's no financing available.
No financing, nothing. Nobody's going to buy it. So many, I would say about 50% of them, we were able to buy back in the first 3 months, and people were so thankful for us to even come there to provide them with an exit strategy. And then we had, 9 that, we bought out over time. So that's been great. The investment's been going very well on that side. Operationally, we increased revenues about 50%. We have renovated.
Wow, that's huge.
Units. Well, we bought it at a very low occupancy. So
gotcha. It wasn't rent raise. It was just your top line. Top line.
It's a combination of renovating units, raising rents, tapping into some of the other ancillary revenues. Parking revenue was a big one there as well, and just fixing everything that we identified from day one. But we're excited about the asset, so we're actually putting that under longer-term financing. We'll have that for probably another 4 years. But we talked about the buy, fix, sell. That's more of a buy, fix, hold, and sell in about 4 years. So it has a ton.
And let me ask you this. Maybe it's just because of the way the fund is structured, but if it's a quality asset like that, and you're able to you've raised the value obviously significantly, you could probably refinance and cash out your well, again, it's in a fund, so never mind. You're pretty much locked into that structure, because it sounds to me like that might be an asset you'd want to keep if it weren't in that scenario.
Potentially, yeah. If it were an individual asset,
Right.
That's not the strategy. But when we refinance, we will return a large portion of the capital for that investment.
Okay.
Yeah. But again, when I talk about some of the things that we're tweaking for Fund 4, as we look at the world, and this could potentially be an asset that we would hold much longer term. But because it's in Fund 2, we have a specifically designed strategy where we are going to sell this asset, but we'll probably hold it 6 years versus our 5-year business plan, because it's going well, and we think we're positioned for more growth in the future out in Naperville.
Well, this has been a real high level conversation. I know some of you guys' heads are probably spinning from this, but let's go back to when you first, and I know you invested your own equity to get started. When you first started reaching out to investors and did either your first fund or your first syndication, I don't know if you went straight to fund or if you did a syndication or two, what did you do to get out there and meet people and get them excited about what you were doing? Can you just give some strategy to my listeners?
Yeah, I mean, it feels like yesterday that we say, because it's very different. We started out, I think, in a much different position as most managers, where we were investing our own capital.
Right, that's very unusual. Sure.
Yeah, and the I think that the risk is exponential when you start managing other people's money. So when we went out, this was in 2010, and it was crazy times there. And we had syndicated some smaller deals prior to that, but we had a good network. We were both had a lot of good friends, high net worth in the market.
People from your trading background.
Background, yeah, and other backgrounds as well.
Okay.
I think I was probably around 40 years old then. And we had a deal that we kind of, we ended up buying a distressed pool of debt from a bank. And it was one of these crazy days when the market was down 800 points and, everything was, and we got this thing for a song. And we sort of stopped and said, look, we can take this down with our own capital, but what do we want to be when we grow up? And so the very first deal we took out to a group, we had to cut people back and limit their, the amount that they could invest, because what we were trying to do is build goodwill with a stable group of investors at that time. And so in many ways, we found a deal that really spoke for itself, and we gave it away. And it was a great
just to build goodwill for future deals.
That's it.
That's brilliant, guys. I really want to flag that for you guys. If you've got a home run deal, and so you actually limited their investments, you could have more people in it, have more people that experience a fantastic return on that particular deal. Because I tell you guys, once you make someone some money, you've got them. I mean, they're yours. They are your rabid fans, and they will be clamoring to give you money and to tell all their friends to give you money. So that's a brilliant strategy, Michael. And sometimes it's hard, when you've got that screaming deal and you've got enough capital to do it yourself. Yeah. But you realize the long-term value of blowing these investors' minds with this incredible return. Awesome. Brilliant.
Yeah, it was
strategy.
the right thing to do at the time.
Yeah.
And it's definitely helped kind of launch and propel the firm. And all of those investors ended up a year later, we started our first fund, if you will. And all of those investors came into that fund.
Sure. And their friends and their relatives.
Yeah.
Exactly.
Yeah.
I love it. That's a great strategy. So let me ask you this. You obviously have incredible success. Is there a dark time in this real estate journey that you'd be willing to share with people? I mean, everybody thinks this journey to success is easy. How about some seminars or times you got your nose bloodied or learning experiences?
No, it's interesting. I'm glad you asked that too, because in this business, you learn a lot more from the deals that go wrong.
No question.
Mistakes. And I know there's probably a lot of investors out there who have invested passively and done things wrong. And I mentioned earlier in the podcast, I had done some passive investing even prior to Origin, and some went fine and some didn't go so well. And it's, the ones that didn't go so well, I learned quite a bit, and it really helped shape my philosophy and then also directed me into Origin. So I wouldn't trade those for anything. But one that, in particular that comes to mind is, I got pulled into a deal by a friend of mine. It was in Austin, Texas. It was a multifamily development, and it wasn't the greatest time. It was in 2006. But it was, I think at that time we were 60% leverage, so no big deal. Great apartment building, but the individual who we were investing with, he didn't have a tremendous amount of experience. And I think what I fell, for was the deal itself. I said, oh my God, this looks like a home run. And, you don't know what you don't know. And at that time, I didn't have a tremendous amount of real estate experience. When I look back, I could look at a deal and I was trying to evaluate people, and he was vouched for by a good friend of mine. But you fast forward a couple of years and we went into very bad time. And I don't really think about this, right? I always look at, the decision that was made. Why did you get into the deal? What were the decisions? So I'm a big boy. The markets went south. I can handle losing money. That's not what happened here. What happened here was that he was an individual syndicator without a lot of money of his own. And he had probably 5, 6, 7 deals that were all going south. And I started hearing things through my friend and, some of the projects that he was involved in. And I don't even remember why I did this or what happened, but I started doing some internet research. And all of a sudden I came across this website where it was a hard money lender, where this sponsor's name was involved. And what he had done is took our property, which was fine, wasn't underwater, it had plenty of equity, and he pledged it for a loan for another property. Well, you can imagine,
Wow.
It was just like, oh my God, and that's just borderline fraud. Well,
sure, it is not borderline at all.
Yeah, so I spent the next year, and you'd think this would be a slam dunk, but working between lawyers and the courts and flying down to Austin and testifying and trying to wrestle this away. And you don't really know how people are going to behave until their backs are against the wall. Everybody's going to look great in an interview and this and that. And I would caution anybody, find out what happened, when things went wrong, and, find the references for the people who they aren't giving you.
Sure.
So, that was a lesson. And I'll tell you, though, I wouldn't trade it for anything, even though I made a ton of mistakes and I learned a ton. But it has really helped shape me as an investor in what I am today and why I do what I do. And if it wasn't for that, I don't think that I would have started Origin. If that would have turned out great and I would have found a great man, maybe I would still be a passive investor today. But, I just looked at it and said, I can do better than this. And my partner and I kind of came to the same conclusion and said, let's do this.
So the lesson isn't just, the lesson was you looked at the asset looked great. Of course, the timing was terrible. I mean, you couldn't have timed that worse than 06, but you didn't look at the operator close enough. So that's a lesson.
Right. Yeah. And
okay.
I will tell you, Rod, that is the common theme. If I look back in the deals that I regret the most, this business is about people. It's not
sure
about
is.
physical asset. And I think that's where a lot of people make the mistake, is looking at, comparing returns to one another. You shouldn't be comparing returns. You should be comparing the people behind the returns. Because, within an Excel spreadsheet, you can make any deal look great.
Sure, you can.
It's not, where the value is.
Or you could get lucky on a deal and have a home run, and you touting that success, and and it was just luck sometimes.
Right, and that's what I was talking about. It's the decision making that matters, and where I kick myself is I look back and say, I can't believe that I didn't do more due diligence, invested with this guy. I'm not, so if everything would have gone well and I would have lost money because of the crisis that's under, okay, I'm a big boy, we can handle that.
Interesting. Yeah, I'm just reading Ray Dalio's book, Principles. It's all about decision making. I don't know if you've read it. It's fantastic.
Oh no, but I have it on my desk.
It's a fantastic book about an effective decision making process.
Yeah. Well, I heard somebody else bring this up, and they had a matrix, and it was just about there's good decisions, there's bad decisions, and then there's good outcomes and bad outcomes. And sometimes the worst thing that can happen is that you make a bad decision but have a good outcome.
Oh yeah, no question. Because
Yeah, this idea that you actually think you know what you're doing, and in the long run, the law of large numbers will prevail, and you're going to lose money.
Hey, my net worth went up $17 million in 06. I could barely get my head through a door because I thought I was a real estate god, and and that's exactly what we're talking about here. You think you know what you're doing, so you get comfortable or lackadaisical, and you don't keep your eye on the ball, and boom.
Well, you're not alone. I mean, I think a lot of people. And I'm probably guilty of it as well, but a lot of people correlate because they have money. They know more than the other person. And I think that the smart investor is one who is humble and understands what he knows and he doesn't know.
And he keeps learning.
Yes.
You have to be continually learning, and
Yep.
and that's a key. Michael, you've added tremendous value today. I'm very grateful for your valuable time on the show. And guys, if you want to reach out to Michael, he's at origininvestments.com, and very impressive, buddy. I really appreciate you taking the time to be on the show.
Well, thank you for having me on the show. This was fantastic.
Awesome. Take care. Talk to you soon.
You too. Bye-bye.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please take a minute to visit iTunes and leave your comments. For more resources or to connect with us further, please visit our website at rodkhleif.com. Tune in next week for our next show.
Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws.